Welcome to the Legal Framework for Blockchain Technologies panel. We have an amazing group of panelists here, and we're going to take a little bit of a different approach. Rather than sort of talk generally, I guess, about the bit license or what a specific state in the U.S. has done. We're going to talk about some really specific issues because I want to tease out some things that I think will stimulate discussion, but also hopefully raise some interesting questions for all of you as well. And on a serious note, I don't think that you are likely to see another panel with as beautiful heads of hair as we have here, and it spans all ages, and this was completely by accident too, but it's a spectacle. So I want to introduce everybody now. So farthest on the audience's right is Dax Hansen. He's a U.S.-based tech and payments lawyer. He's a partner at Perkins Coie in Seattle, Washington, and I think Dax, at least from a legal standpoint, you have probably been in the virtual currency space longer than anybody. Kathleen Moriarty is, Kathleen, raise your hand. Kathleen is a partner at Kaye Scholer in New York. She was instrumental in getting Spider, which was the first ETF, up and running. She also represents Cameron and Tyler Winklevoss and has worked on their Bitcoin projects, which includes a Bitcoin ETF and their virtual currency exchange. Ruben Brahmanathan. Ruben recently joined Coinbase as associate counsel. You are an Australian native, correct? Okay. But recently moved to San Francisco and is with Coinbase. Ayako. Ayako Miyaguchi is managing director in Japan for Kraken, a US-based virtual currency exchange. Ayako, interestingly, also serves as the foreign affairs lead for the Japan Authority of Digital Assets, which is a self-regulatory group in Japan that acts as the liaison between the virtual currency industry and the Japanese government. Juan Llanos is our resident AML and compliance expert up here today. Juan has been an executive and advisor in the payments industry for many, many years. He was most recently the EVP of Strategic Partnerships and Chief Transparency Officer at BitReserve, which is now Uphold in New York. And he advises almost a dozen virtual currency startups on compliance and AML related issues. Dana Syracuse. Dana is now managing director at K2 Intelligence in New York City. Before that, he was associate general counsel at the New York Department of Financial Services and was instrumental in shepherding and creating the bit license framework that was released earlier this year, and also did a significant amount of work on the trust charters that were received by ItBit and Gemini in New York, which was seen as a pretty creative regulatory move from an exchange standpoint. George Frost. George is a fintech lawyer based in California, and has been general counsel for Bitstamp, which is one of the world's largest virtual currency exchanges, and we're happy to have him here as well. So I want to. My name is Andy Beal. I'm a corporate attorney in Los Angeles, and I have beautiful hair, and that's the prerequisite to this panel. I've been in the Bitcoin space for a little over 2.5 years now, and advise startups on state, federal regulatory issues and compliance. So I want to start out by talking about an issue that I think sort of transcends industries, and that is, or would be important to a business that's doing securities, commodities, currency, any iteration of the blockchain for any industry, and talk about ownership of a blockchain-based asset, because I think that's really interesting. And the first question I want to throw out to the panel is, how do we prove ownership of a Bitcoin or any other crypto asset that sits on a blockchain?
Digital bearer asset. It's a digital bearer asset. A token is a digital bearer asset, but I'll let the experts talk about it.
I was just going to say, I think the current thought is that whoever can control it is the owner of it. So if you have the private key, or if you have one of several multi-sig keys, but you're the one that ultimately can move the asset or not move the asset, then you're considered the owner. Is that fair?
It's a ledger entry, and whoever owns the ledger entry and multiple nodes publish the ledger entry. If you own the public key associated with that ledger entry, then you own the asset. I think that's the assumption, but I think one of the items that you probably have lower on the list is it unencumbered? That's another question, right? I mean, that we feel like we own the asset because we hold the private key. It's a public-private key pair, but there may be some weaknesses in that assumption.
So let me piggyback off that and pose a different question, which is, if I'm an independent third party that's looking at a blockchain ledger system, let's say for property assets, without doing any other investigative research, is it possible for me to tell whether an asset that resides at a particular address is actually controlled by that person or owned by that person?
I think the point here is that even though control is the best analogy we have for ownership on the blockchain, it's not perfect. So although you can prove that someone has control by someone signing a message or initiating a transaction with their private key, you actually can't prove things like exclusive control. And then, of course, you can't prove what's happened at one layer of abstraction behind the blockchain or above the blockchain. That just because the bitcoins at an address haven't moved doesn't mean that the ownership has changed by some other transfer of the private keys. So it's an imperfect analogy.
Yeah, I think the concept of control is probably wrong. It is a matter of, depending on what the configuration is, if it's a multi-sig or if it's 1, 2, whatever it is, it's the concept that you have access to or potentially have access to. And then the added layer to that is, there are different ways in which multi-sig winds up getting implemented, and it may be the fact that you need to look at what's the contractual relationship between the parties. What is the intent of this multi-sig configuration, then how is it practically being applied? It can get incredibly complex.
So Dana, you were a former regulator. How important is, I guess, the issue of control? I know, if I were to pick up the phone and call California, New York, or Texas, their general answer to, is my business regulated, is going to be, do you control customer funds? Do you have custody of customer funds? And you just brought up a wallet scheme called multi-sig, which basically is an attempt to sort of distribute the control in an attempt to distribute the risk of loss, essentially, or to make it harder for someone to hack into a wallet and steal funds. And it's been a powerful security tool for exchanges, and it's also been, I think, something that, as a lawyer, you are trying to use to sort of separate your business from a business that needs to be regulated. And I'm curious, whether or not that accomplishes that separation that a company's looking for, or is it just a tool that mitigates a risk but doesn't completely erase it, or perhaps it raises new risks that weren't present before? So,
a couple of things there. The concept of multi-sig, I think it's a great example of, how and why regulation in the space is going to need to evolve over time. The bit license process was a 2-year process. When the first draft came out, multi-sig wasn't even a thing yet, and it was through the comment process that we heard about it, that it started to develop over time. And I think that future incarnations of regulation are going to really need to take that on, and also take on the kind of the new evolution that's happening in the space. Now, the bit license talks about custody control. That's actually a misnomer. It's what it really should be about is access to or potentially have access to the account. So I mean, this is all kind of a long way of saying that, multi-sig isn't necessarily something that's a licensable activity or should be a licensable activity. It should depend on how it winds up getting implemented. And that will require a look at the organization. It will require maybe some of these organizations to go to the regulator and discuss their model, discuss what they do, and potentially ask for some sort of no action letter.
Can we tease out a little bit some of those comments that Dana you just made? So I think you said custody controls maybe not the right terminology, but I think you said access.
So,
And I mean, these are all, I mean, we're lawyers, a lot of us, and people in the legal regulatory space, words have a lot of meaning there. But can you tell me, like, why is access a better?
because no one to say custody or control, no one ever actually holds Bitcoin. That's why that language is imperfect. What it's really about is you've got the public address that's sitting on the system, that's sitting on the ledger, and then you have one key or an assortment of keys that may or may not allow you to have access to that coin, to that currency, that contract, to whatever it is. So that there are two different ways that you could draft it. One, and with two drastically different meanings. One is that access to the credentials that may provide, or you could also say access to the credentials that will provide. And depending on which way you go in that language will show you're going to, you're not going to license any multi-sig configurations to, depending on how it winds up getting implemented, you may license multi-sig configurations.
And so access to the full full ledger entry, because I mean, isn't the point that you have the ability to exercise control over it, to move it to another location? Because I would argue that in a multi-sig environment, some people are holding onto one key that allows them to access the Bitcoin or to effect some sort of control, even if it's negative control over the asset.
So, I mean, this is where things also wind up changing quite a bit, I think. You will have a situation where there's no multi-sig configuration, where there is no possibility of absconding with the coin. And that may lessen the AML controls in the licensed environment. But clearly there are consumer protection concerns. There are cybersecurity concerns. I would almost say that it's akin to a safe deposit box. You go and you open a safe deposit box at a bank. You know that person can't get access to your box, but you want to make sure they're not leaving the key out on the front door.
Yeah, so we're stuck with custody and control for the time being, and it's really an artifact of a strong box and a stagecoach. And I think the real legal point is hold somebody responsible, namely the driver of the stagecoach. And I think a lot of the I don't think we have to parse this too finely. I think these can be established contractually, what the legal relationships are amongst multi-sig vendor and so forth. I don't think we need to really look that deeply into what the control relationships are personally. I think you can handle it contractually. And regulators just care about being able to put somebody in handcuffs if they need to. And to use a very stark example.
All right. So a couple pieces of technology were mentioned there, and I guess my next question is, are regulatory bodies or the staff that they currently have, are they adequately equipped to look at a multi-sig implementation and say, this is good? Are they adequately equipped to analyze some of this technology, or are they going to have to evolve as well?
I would venture to say that depends on a case-by-case basis. I don't know what, Dana, you'd answer from your own experience, but my experience with regulators is it just depends. Some regulators, some of the staffs are very up to speed, some are not. And so you can't assume that they are. You can find out pretty quickly whether they are or not. And if they're not, then you're going to have to go through an education process first before you can talk about the issue.
Yeah, I think as it stands right now, There are few regulators that probably have the expertise to make that analysis. But also, even if they have the expertise, there's also the willingness to go out on a limb and make that decision. And, there are very, I would call them simple, money transmitter type applications with, some new technological issues that they go to a regulator and they just kind of sit there because nobody wants to make a decision. Now, regulators are going to need, as this grows and as Bitcoin as a currency grows and as blockchain grows, regulators are going to need to staff around it. And they're going to need to look to people that have this ability. Now, maybe you wind up having the same crew that is doing your cybersecurity work do this because they're already at a certain place. But if this is going to be the future, regulators need to work together to come up with kind of just regulation, but also to realize that this is going to be a regime going forward that they need to live with.
In my personal experience, regulators, examiners within regulators are rather unsophisticated, and they are basically there to enforce what's written in the regulation. So I think the concern should be whether policymakers are equipped to design the right framework that then will be translated into regulation. That is where I think we need enlightened, forward-thinking, forward-looking legislators. Yes.
Ayako, is this a conversation that's occurring in Japan? What's the
Yes, JETR has been discussing with FSA for the upcoming regulations, and they are pretty, it's just recently, but they studied and learned quick about all the technology and the possible applications. And something like multi-sig and distributing risk is what regulators want. Although I believe, like Kraken has been offering multi-sig before multi-sig was a thing, as you mentioned. But it's something like you have to publicly see to probably make, partially to make regulators happy to, or to make the public feel safe. But in reality, like distributing risk doesn't mean the safest thing. It depends on who is holding the key.
I think that's an interesting point. I think, you can be an exchange that introduces multi-sig, but if it's a really shoddy implementation, it's not going to be that helpful. So it's important to, look at the technology, but also really nail the implementation. Was there a question over here?
Hi, I'm Greg Metcalf, Chairman of ASIC. But I'm also the chair of the International Organisation of Securities Commissions, which covers 120 countries around the world, so, and a member of the Financial Stability Board. So, thank you. No, I was just going to say to you that, I suppose domestically on fintech and blockchain in particular, certainly I think we've embraced it. I mean, we've established an innovation hub, and we've actually said, we're putting us off the ground. We said we're willing to modify the law to the extent we can to facilitate digital innovation. So, we're very keen because we see the opportunity to allow competition ultimately benefiting consumers. So it's certainly mine, but also ASIC's, and sometimes a problem of rolling that through the organisation, but that's certainly our view. But on a global basis, I can tell you that at IOSCO, we've established a blockchain task force. What we're trying to do as quickly as possible is actually try and get countries to think about what you're talking about now, how you embrace this, how you enable it, how you regulate it, but it's a different style of thinking. So in the next board meeting of IOSCO in February, we're actually going to, around the world, the chair of the SEC, the people around the table, we're focusing a whole day on blockchain and what it potentially means for markets, for clearing, for settlement. So I think, and I think it is really important that the regulators actually move quickly, because I always say to people, my theme is let's harvest the opportunity, let's mitigate the risk, but let's harvest the opportunity. And I do think there's great opportunities in all this. So, I will say, I think the skills, clearly this is moving very fast, but certainly, and that may mean in terms of skills, we either recruit in the skills or we second the skills, and working with, like our innovation hub, we're looking to maybe second people to block and chain. So I do think having that collaborative approach is going to be really important. But I do see just fabulous opportunities out of all this, frankly. But it does mean the laws probably, we can do a certain amount of modification. The laws we're going to have to change, I think, for a lot of this stuff. So just thought I'd add that and that's why I'm here, was to listen to what you're talking about. Thank you.
Absolutely. So that's actually a perfect segue to the next thing I want to talk about, which is okay, absolutely.
Am I on? Yeah, that's better. Just listening to that previous concept around using access to having the keys as some sort of indication of provenance seems a little bit odd in my mind, because in the present banking environment, you can lose your keys to your accounts, in terms of you could lose all of the information, but provided you could come back and re-establish your identity, then that would actually be the key to regain access to all of your assets. So I would have thought, isn't the concept of identity and being able to properly express and then re-express your identity as far as the provenance for those transactions is more important than holding at any given moment a given cryptographic key?
Yeah, the problem is that the technology doesn't work like that. If your identity can be established and expressed, but if you don't hold the private key that can sign the transaction and prove ownership, you don't own it. It's a bearer assets. Every blockchain token that allows the signature of the transaction and the approval of ownership and approval of the transfer is a bearer asset. So it's even worse than throwing an ingot of gold in the ocean, because you actually can see it, but you cannot touch it. It's like, those movies. You can see the ledger, the account, and you can see the balance, but you cannot move it. So it's even more frustrating.
That plays enormously to the valid use cases for like an open distributed ledger, if that's what you're dealing with.
But it's not that drastic, though, really.
Yeah, I know.
Well, I mean, go ahead. Go ahead.
I was just going to say that's the correct view. If you look at Bitcoin as the protocol layer, that is absolutely correct. But in the traditional financial system, there's a lot of other layers built on top of that, right? The service, the compliance, the settlement layer. In Bitcoin, that's true of the protocol layer, but then you have services like Coinbase and other wallet providers for those who choose to use them, who control the private keys. And if you lose your password, you can reestablish your identity and get access to your funds that way. So that's probably the answer.
And on many other levels, you can map your private key, which is this alphanumeric string, to a passphrase or something, right? And so it's easy to remember. If you lose it, you can recreate it. You can back it up on Dropbox. I mean, there are a number of other ways to make this friendly.
What was your secret phrase?
Yeah.
Say that again, Dax.
Fair enough. My point really is that you can recreate it. I mean, it certainly is the case that you need your private key to exercise control over the entry or over your asset, but you can. There are a number of mechanisms designed to make sure that people don't lose it, or if they do lose it, they can recreate it. Or they can recreate it browser side, some cold wallet solution, or some other custodial arrangement, as Ruben described.
Yeah, these are getting better over time as well. The hardware solutions, the passphrase type wallets, and these solutions are becoming both easier to use and more secure. So if you don't want to use a centralized service, you're still able to store your Bitcoin securely, privately.
It requires a lot of user education, though. It's just as the internet or blockchain or Bitcoin is democratizing control and finance to the edges, to the ownership, to the individual endpoints. Security is also being democratized. So now you have to, as a user, you have to be doubly concerned. You're proud that you control the asset, but if you lose it, there's no recoverability. So there's a paradox there.
I think most consumers are going to want the ease of use and the safety of a hosted wallet or a provider who is subject to financial regulation, is considered a financial institution. And, I do think you can still get most of the same benefits, from that. And I do think even, the exchanges, which everybody wants to disintermediate now, and considers the dinosaurs, forget the banks, they're way back. But it's the exchanges that are the target now. So, I do think personally that once exchanges figure out a way to have a universal identity system with a portable identity that is easy to use and can't be ripped off, and that really belongs to individuals and not to the giant corporations, I think that will be a very compelling vehicle for adoption. Yeah.
Yeah, it seems like a lot of these technical consumer risk problems are sort of a function of how immature the technology stack is right now. And as Ruben talked about, as you start layering, applications, whether it be identity, compliance, transparency, et cetera, a lot of these things will get resolved.
And I think that these are also issues that need to be resolved sooner rather than later, because these are the kind of things that wind up being barrier items to people getting their brain around it and actually entering the marketplace to use this as a currency.
I mean, let's admit it, using a public-private key pair is not the best user experience, right? I mean, it's not intuitive. It's great for
passwords.
right, but so we need to keep in mind that this technology is at its beta level, alpha or beta level, and I think the end goal is that it'll be easy to access, just like you access your browser, or whatever it is, your online banking, Facebook, whatever it is. That there will be security mechanisms built in to where you're exercising control over your private keys, but without having to keep track of it or fear that you're going to lose it.
With all the biometrics built in, and hopefully under the control of the individual again, and not in some giant database at Google. I mean, that's my own hope anyway.
All right, so I want to move to securities, and it's been an application of the blockchain that I think has gotten a lot of attention recently. I think you've seen a lot of high-profile pilot projects that have been announced, whether it be a stock exchange or an over-the-counter exchange. And so, Kathleen, I want to turn to you because you're our securities expert here. What first, I guess, to sort of establish a foundation, what does it mean to clear and settle a securities trade or a transfer, and how does it work today? And then we'll move forward on how blockchain may affect this.
Well, I'll make it really simple. I'll only talk about stocks, not bonds or commodities or other things, because they all have slightly different rules. But basically, the idea is that if I sell you a share of IBM, the back office mechanism is such that the trade will be processed in such a way that it will eventually come to your account within 3 days. And that's called T+3, trade date plus 3 additional days. So if there's a problem, if you don't receive your share of IBM from me by the end of T+3, there's been a problem for some reason. Other than that, it's okay. Now, a lot of people think this is incredibly inefficient, and some people feel that this is also, this particular system provides certain benefits to high velocity traders and arbitrageurs, because if you're a broker-dealer, you actually get T+5, not T+3. So there's an opportunity for you to short sell and take a profit and then show up with the stock within T5. So there have been a number of discussions of people creating new programs on top of these various chains to create immediate settlement, because as you know, the transaction between me and Juan on a blockchain is instantaneous once I give the permission with my key. So that's the thought is this will radically cut down the time of settlement and will cut down the inefficiency of settlement, may cut down some of the unattractive aspects of settlement that exist right now. question I have for people, because I know probably everybody's been involved somehow in one of these projects, is if we have, my understanding is most people are creating their own private chains. So you have Group X has one set of chain that's going to do the conversion, and Group 2, Group 3, Group 4. Now you're basically dividing clearance and settlement, whereas right now you have a centralized clearance and settlement system. I'm only talking about the US, by the way. You have one system that clears all equity securities at any given time. And if you start asking each group to have their own, you fractionalize that system. And the question is that a problem? I don't know necessarily that it is, but it strikes me whenever I hear going from a system that accommodates everything to a system that only accommodates certain things, my question is always, is that really efficiency?
And I'll make a quick comment on that. I think that you accurately point out that for these very sensitive situations, you need one protocol, right? And that we haven't even built one of those yet, right? And we have not yet decided how these multiple platforms might interconnect. But I guess I'd say that I'm hopeful that there is the ability to interconnect, because at the end of the day, this is protocol. These are protocols, internet-based protocols. Just much like information moves over HTTP or some other protocol, we're doing the same thing with financial instruments, financial information, and that to me there is we're not connecting proprietary software together. You're connecting open protocols together across the internet, across the common backbone. I mean, luckily we have the internet to build on, right? I mean, my understanding is that, again, the securities clearance settlement systems were all built kind of pre-internet, and so we have the ability to use kind of consistent protocol levels, software stacks to build on top to make these things interrelate. And presumably smart people are working on that, they're thinking ahead on the interconnection of these. But we don't want to have a VHS Betamax problem, right? That these need to all interconnect. But I'm hopeful that they can.
Yeah, I mean, I'm hopeful that they can as well. I think that, in order for it to happen, these companies need to want it to happen. And right now, they're still in such competition with each other that they're hoping, in doing that, kind of like the primaries in the US, people are going to drop out and there's going to be one leader. But I think ultimately, these systems need to be thought of and regulated almost as a utility, because that's really what it's going to wind up being. I'm hopeful that you'll wind up taking the best parts of each one and creating one solid organization. Now, the issue that I'm concerned with, obviously, is how is this going to wind up being regulated? Right now, we don't have the regulatory language about how to regulate a blockchain, just purely a blockchain, or how to regulate the tokenization. What we do have language about is, if there is an asset that's been tokenized, such as a precious metal or a security or a bond or what have you, we have the AML type language around that. So I think that there's a real opportunity for the blockchain community, but also, the companies that will wind up being customers, the financial institutions that will wind up being customers of these chains, to come together and figure out what that regulation should look like, and then almost package that together, and then then interface with the regulators, because no one's going to know these systems and these issues better than industry.
But aren't they going to come up with just proprietary systems with patent, walls everywhere? And I don't see that leads to any great commons, where we're going to have a worldwide, equity trading system.
Right. So are we going to centralize decentralized technology? Right. That's the risk.
On the United States, as I understand it, that the Depository Trust and Clearing Company are spending a huge amount on seeing how they can adapt to blockchain going forward, because clearly they see it as a massive threat to their business. So from what I've heard, they're moving very fast. Also, on the regulatory side, on the call we had last night, I understand the Fed, et cetera, are pouring a lot of money into trying to understand how they're going to regulate blockchain. Bill Dudley and Dan Torello last night, the Financial Stability Board are saying we've got to get on top of blockchain because it's coming so quickly. On Australia, as you probably know, the ASX is actually looking at blockchain in terms of the next generation of clearing settlement. So I think what you are going to see is if you want the old world businesses realise that they're going to have to catch up very quickly. So I'm not sure that I can see. I agree with he's got the Nasdaq. I think I've got this private equity thing they're developing at the moment, but I expect that the those if you want legacy businesses possibly going to catch pretty quickly actually. So I probably wouldn't be that pessimistic. I think they're moving pretty fast actually.
I think one of the issues is, when you have, like the SEC looking into it, it winds up being what's their jurisdiction.
They're a law enforcement body.
Yeah, but depending on, who it is and which regulator and what, they're always very concerned with their jurisdiction. They're always very concerned with getting out ahead of other law enforcement or other regulators. And the problem with blockchain is it has so many different applications that the danger is you're going to invite, the alphabet soup coming after you.
I think the SEC is quite different, I think, to those others because their philosophy is about law enforcement, whereas people like the Fed are more about facilitating markets. So I think you've got a different, and actually the CFTC are very engaged on Bitcoin, on blockchain, very engaged. In fact, they've been doing a lot of work around blockchain with CFTC. So it depends on, I think, you're right, depends on the regulator, I think, yeah.
You sure you're not from the U.S.?
I did spend 10 years on Wall Street, but I was on the other side. Yeah, that's right. The accent's not there. Actually.
So I want to ask a different question and piggyback off something Kathleen mentioned, which was, a lot of the motivation for using blockchain is to make things happen faster, speed. And there's a reason why when you buy a house, you want an escrow period as a buyer. And I'm wondering is faster necessarily better for everything? It's great for peer-to-peer money transfers, but is it great for every market?
Well, isn't having the ability to move it faster the great innovation, right? I mean, we can also slow this down. I mean, escrow, smart contracts, you talked about other tools, right, that in certain instances, if you wanted it to take a few days, there's other electronic tools to make that happen. But if you want it to move faster, this is the technology that allows it to move that way.
So you can have circuit breakers, built into the protocol level. What happens when there's a market meltdown and everybody's, robots are, racing one way or another, and it's all getting recorded on the blockchain. I don't know. I'm serious. Who's got the answer for that one?
But it wouldn't be at the protocol level, right? I mean, if you wanted to, you wouldn't put a circuit breaker in there. I guess you're saying things happen real time, the ability to record them, right? Of course, but that if I wanted to have an escrow, it just doesn't get recorded. But in many instances, you want it to be recorded quickly.
Speed is desirable when you need to release funds that are parked somewhere as collateral, or when there's final settlement. Why would you need to? For example, recovering a loan or syndicated loan, multiple parties contributing to the payback of the loan. If you have a settlement finality, why would you need to wait 20 days for a syndicated loan to? So the benefit is there in releasing the funds that can be reused for better use. The question is that speed, as Kathleen was saying, is a safeguard, right? Sometimes it's to prevent something. It's meant to prevent something like short selling or manipulating the markets. So it's
or a mistake.
Complex. Or a mistake, exactly. Sometimes you need to correct an error in transit, and it's better to have it in a limbo state that can be modified.
Excellent. All right, so switching gears, I want to move to another sort of big topic that, did you have a point on securities?
I was wondering how loans can exist in a blockchain-based environment. Can that be regulated? Loans, because Bitcoin can only be owned by the person who controls it. If banks were using cryptocurrencies, how could I take a loan from a a bank.
You cannot take a loan on the Bitcoin as an asset or as a currency, although you could, but we're talking about representing the token representing a real money or real asset loan, right? So registering the loan and the control of the loan, all the conditions for the loan to exist, the participants, the time frame, the payback period, and everything. That is something that can be controlled in a blockchain, right, as part of a smart contract. But the Bitcoin itself, as a currency or as an asset, I don't think there's going to be restrictions there for
Sorry,
complications.
Juan, I think it comes back to, again, the protocol layer of Bitcoin as the transfer mechanism and simply the clearance of a loan, an obligation which exists outside the blockchain. But the difference between the existing financial system and the Bitcoin blockchain is that there are other things baked into the protocol like multi-sig and time lock, and that's those sorts of things that can be used to more effectively manage loans and other contracts.
And I think Bitcoin, there's a lot of peer-to-peer lending things that use the Bitcoin as collateral, and they work just fine.
No more?
I have a question. It's for start, it's for Kathleen, but anyone else. And that's what we've been talking about at the moment with securities is essentially how you can digitize an existing securities regime, right? And I've got a question about the technology. Do you think this technology can actually facilitate the creation of new financial instruments? New financial instruments that don't exist anymore? Or is it just about making existing financial instruments, making the trade a little bit more efficient?
Well, I think, again, the answer would be just what Ruben said, not the actual base layer protocol, but what could be built on top of it, as a next level or as two next levels on top of it. Yes, I can't imagine what they would be because I'm not an investment banker and I don't make that kind of money, but I'm sure that using this protocol with layers, you could stack it up and create new things that have not been possible until now.
Crowdfunding or micro collection comes to mind. In order to access certain products, there have been restrictions. There are regulatory restrictions, investor protection restrictions. But now imagine that you could distribute the funding of a project, or you could buy a micro security or a micro share of a concern or business. That is one of the things that I think is potentially viable with this.
Yeah, one more point. I think when you're dealing with securities and the definition of a security is so broad and expansive and is basically as broad as the notion of fraud itself in a market, and being able to defraud somebody. And I think the SEC is very zealous in making sure it's open-ended and practical and that we won't be able to digitize it entirely. I mean, just like the peer-to-peer lending folks who thought they didn't have anything resembling securities, suddenly they were classified as securities. And they had to, every loan had to be, separately, issued as a security.
To everybody that's got a question, I've got one more section of issues I want to touch on, and then I'll try and leave 10 minutes at the end. Is that okay?
Can I just throw something in? I'm not sure if the panel's aware that we are fully dematerialized our cash equities market. So there is no share script sitting in a vault in DTCC or an equivalent. So, and we've been like that for well over a decade. So, because many of you sound like you're from the US, you might not be aware that our cash equities market, $1.5 trillion.
Actually, that's the same as in the US. Most everything is done in street name. It's certificateless. People no longer have stock certificates.
Sure, I understand that, but they do exist in vaults in the DTCC. We don't have that at all. We are digitized.
All right. Anybody else that has a question, I'll make sure to leave a few minutes at the end for it. I want to move to anti-money laundering and identity, because I think that's a big topic too, and again, an issue that sort of spans, across use cases and applications for blockchain technology. And Juan, I want to highlight something that you have said several times, which is, at least at the moment, we are able to identify funds flow and transaction amounts before we're able to identify who the participants are, which sort of turns the existing, compliance model on its head, or at least introduces new challenges.
let's think about how the system works today, how enforcement or deterrence of crime works today in financial services. So in account-based systems or depository institutions or any financial service, you first have to identify yourself before funding the account, right? So you open an account, you fill out the forms, and then you fund the account, and then you're able to trade with that money or move that money, right? That's kind of the paradigm. It's identity first, payment, and funding and payment later. But what the blockchain did is it allowed for payment to travel independent of identity. So I don't know if you're aware, but the audience is aware, but it's the first time in history that you can do a remote payment without showing your identity. That is what Bitcoin allowed, and this is one of the revolutions in Bitcoin. You could pay remotely over the internet to someone you didn't know, you didn't trust, you didn't need to trust, without first opening an account, without first opening a profile with PayPal or with your intermediary, right? So you couldn't say, and that's basically what why Silk Road thrived, because you could pay for a good and of course hope to be delivered, but you could pay without revealing your identity. You could use a pseudonym, which is what Bitcoin has, a pseudonym, right? So, and when we make a payment today, if you think about using a plastic or swiping a card, you're actually transmitting your personal identifiable information with each swipe, which is absolutely crazy. So you're exposing your own confidential information, the expiration date and the CVV of your card, and everything on your card, which is encrypted and encoded into the mag stripe, and now in a chip. In every payment, you're exposing that information to the merchant, to the quality of the POS device, to the transit, the security of the network. So that paradigm is shifting now, because you can make a payment without identity. And that is a huge, it turns KYC, know your customer, which is one of the primary obligations in anti-money laundering or financial crime prevention, in its head, right? So and a second thing that is revolutionary with the blockchain is that every single transaction that ever took place is recorded on a publicly viewable, transparent ledger. So we are all able to see the balances and the movement in and out of that ledger, but we don't know who the owners are. So we have radical transparency without identity, and we have the ability to make a payment without identity. And that is a huge problem. This is what attracted me to Bitcoin initially as an AML expert or a practitioner, basically. So I said, well, this is going to be attractive to criminals, because you can send payments in any amount, $1 million, $100 million globally, and you don't have to show your ID to anyone. So, so the paradigm is shifting from will have to shift if we're going to enable these payments to know your customer, from know your customer to know your transaction, because now we're some of us are working with companies and it's possible to work to do Bitcoin intelligence, to do enormous amounts of analysis on this public ledger. It's a publicly accessible database, basically. So you can trace payments, you can trace inputs and outputs, you can see what's going on, you can actually do intelligence on behavioral analytics without knowing the identity. So the paradigm is, or the challenge is, how do we make the current regulation fit into this world where we have now full knowledge of the transaction and imperfect knowledge of the person, of the entity?
I think that kind of individual use of Bitcoin, the individual to merchant, what have you, will ultimately remain unregulated. I think it'll be thought of by regulators as somewhat of like a cash transaction. I think that what you're going to see and what you saw in New York was, the question is, are you transacting through a financial intermediary? And then it's that financial intermediary that winds up being the regulated entity, so the wallet company, the exchange. Because you're 100% correct. Right now, it's not really possible to tell who that individual is. But also, just as a practical matter, or as a philosophical matter, I don't think that individual use should be regulated. Even if you had the ability, it would be like regulating individual use of cash. And I think that regulators are going to agree that that would be improper.
I think for the merchant to accept it, though, it might be important to have a portable personal, identity system in place for the peer-to-peer level. And I agree with you, it probably never will be regulated, but for the merchant to accept it, you need something with a validator, a third-party validator, or some system in place where you get a green light on that transaction. And I think that's all developable. But for the current system, having just applied for the BIT license and knowing what the KYC requirements are, it's really extensive KYC, much more extensive than any bank subjects their customers to. And we can follow what they're doing. And
Well,
Mike
that's because we're an exchange, right?
yeah, because we're an exchange and or a hosted wallet service, you can do this.
But because of what everyone said, we have been, as an exchange, our compliance team has been spending more and more time on responding to law enforcement inquiries, because exchanges are the places that you can actually identify people.
I think it's worth pointing out that you're right. I mean, identity is important, and it is going to come, and that's going to legitimize a lot of the transactions. But even if you don't have a kind of a consistent identity solution, these blockchains, the Bitcoin blockchain, is becoming more and more identifiable over time anyway, just because people are publishing their Bitcoin addresses, wallets, there's information that's kind of leaking through, and it's backwards compatible. So in other words, you had a pseudonymous system to begin with that's becoming now more identifiable. So there are data elements that can be obtained, which raises kind of an interesting point when you come to this tokenization, right? I mean, in the credit card context, we know the credit card context doesn't work. So we've got chip and pin, EMV, right? Everyone's moved to tokens for credit cards. But very interestingly, in the credit card context, you might only share, instead of when you do it swipe, whereas previously you'd send all your personal information. In the credit card context, you'll only send a token, whereas here it's all built on Bitcoin. It's all built on a
translated
token.
behind a
but,
firewall.
but there may actually be more information available on the blockchain where we need some financial privacy on the blockchain. So instead of it being an anonymous tool for money launderers, we might need financial privacy protections on the blockchain.
But the same concept will work, I think, and be very simple.
Well, the solutions for retail people already require that. If you open an account on Coinbase or you open an account on Zappo, they require a copy of your driver's license and a copy of your utility bill, all within about 3 minutes of each other, before they'll entertain anything. So it's
To summarize or to explain this more clearly, the purpose of KYC, of forcing someone to identify oneself, is just a deterrent to crime, right? If you have an anonymous system like Liberty Reserve used to be, right, or those systems that were closed systems that were attractive, Eagle to some extent, the product itself is vulnerable to abuse. So the whole purpose of KYC, which is the screening or the onboarding or the due diligence of the customer, whether it's an entity or a person, is to deter crime. So, and the goal in general is to make people arrestable and funds seizable, to repeat, George. So the whole purpose of law enforcement or enforcement of anti-crime, anti-financial crime regulation is to make people identifiable so they can be arrested and funds seizable. And these are two things that blockchain and smart contracts and pseudonymous addresses create, those things create challenges to the current paradigm. So there will have to be new approaches or probably changes in approach to enforcement to accommodate that.
They create a different paradigm, but it also creates opportunities for things like reg tech, where the regulation, the oversight itself can be expedited through these technologies.
And the transaction monitoring is leaping ahead of the CIP programs, and there are vendors here now who could show you a schematic of every transaction that's happened on the blockchain, and you can see where all the dark markets are, and you can break that down and follow individual transactions, and it's pretty amazing.
So I think we have an opportunity here to build the tools and to build the mechanisms which will achieve these results on a new protocol, and we can improve on the tools that we currently have, which are pretty blunt force and they're pretty overwhelming and they don't really allow a lot of financial privacy. So we have an opportunity to build tools on the new open Bitcoin protocol that will achieve the desired results and also protect privacy. But the problem is that in applying the existing rules to the new protocol, we have this teething issue at the moment, and that's really a degree of friction that we're dealing with.
All right, we have 5 minutes left. I want to open it up to any other questions that we had. Mike should be going around.
It's just a question for Juan. You're talking, if you replace the word cash with Bitcoin in many of the things you were just saying, cash can do all of those things that you're describing. And so it seems very interesting to me because fundamentally Bitcoin came about regulatory arbitrage, and all of the use cases where there are protocols on top of that, the greatest value are those which do perform that function. So, could you comment on that, please?
Well, if you think about what can happen with cash, what can happen with, I always talk about, for example, I've shared the stage with former money launderers, Humberto Aguilar, for example, who used to help Escora Gaviria. He spent 12 years in jail for that. Robert Mazer, who is a secret agent that helped discover the BCCI situation with the bank that was laundering funds for all these narco traffickers in the 80s and 90s. So, and they tell me that there's two ways to launder money. One is physical transportation of this anonymous token, which is the banknote, right, in bulk quantity, and then bribing people that the people will control, management overrides, parallel accounting systems. So this is how money is laundered today. So and we as financial institutions are deputized by law, by this global regime, anti-money laundering regime, to control, to screen funds and people that might have indications of being risky, right? Patterns of risky behavior or prohibited people or entities. But we can only do transactional analysis within our institution. We cannot do intra-company or intra-industry transactional analysis. And the only mechanism that exists to share information are, they're not instantaneous. You have to fill out a report, protect yourself from safe harbors for civil liability. You have to do it's a bureaucratic process. But now, with blockchain technology, now you have the ability to trace funds globally without asking for permission, without contacting the judge in Japan. You can see from your house in Alabama, you can see funds that could be rolling around globally and could have been could have touched multiple jurisdictions. So it's a whole completely different paradigm. So it's a very interesting in the sense that it can be, everything is traceable, transaction monitoring is amazing, but it's completely different from cash. Cash systems are mostly, I would control money laundering in the harbors, right, in containers, because that's or airstrips, unknown landing strips. That is where money laundering happens. It doesn't happen in regulated financial institutions.
So I had a question with the example you gave earlier about buying a house and needing an escrow period. I just wanted to touch very quickly on smart contracts. So in the smart contracts, in a blockchain sense, my understanding is if it's not honoured, that smart contract merely falls apart. It's not honoured, which is quite different to if you're buying a house today and a contract's not honoured. You go to a court, the judge says, yes, I order you to complete that contract. How do you think a regulator or a policymaker is going to approach a very different environment where a smart contract merely falls apart, is totally redundant, finished, ended, versus the current state where a judge can look at a contract and make actual demands and enforce it? Do you have a view on where regulators might go with that, or is that something that they'll just have to accept?
So I think we're probably talking about different types of smart contracts, because one of the fundamental aspects of the smart contract is the self-execution. So in that sense, you're talking about the contract doesn't fall apart. It completes in one of two ways. In that example, maybe it's returning the funds to the buyer, or to the seller, or to the buyer. So it's going to complete one way or another.
Yeah. So if I'm the buyer of a property, say, today my options are, yeah, I can accept the funds back, but I can also go to court and say, I actually want you to complete that contract. In traditional property law in most countries, I have that option. Sounds like in blockchain and smart contracts, the option to enforce a contract that is very close or has actually failed just doesn't exist anymore.
Well, I think
See why you couldn't write it in. It's contract law is very malleable, and it just reflects agreements between individuals, and it can be written very informally or very formally. I don't see why it can't be encapsulated in code. We just haven't taken it to the judge yet. And I do disagree that, well, let me rephrase that. I think there are going to be cases where these smart contracts are void and voidable. I think there's going to be cram down provisions, like terms and conditions now that you typically see on websites that you visit, and questions of unconscionability and equality of bargaining and all those things that will invalidate contracts. And judges are going to come in and say, no, that's bullshit. And there'll be class actions. It'll be just like we see in the real legal world, where contracts fall apart and people have disagreements. So, but the way it's written, I think in code doesn't really make that much difference. I don't think.
I think in terms of property and registration of land, I think you'd want to be careful to guard against things like what happened with the MERS system in the United States, because there were definitely inefficiencies and huge failings there that hopefully could be fixed through blockchain type solutions.
Tessa, if you have a quick question, we'll take it.
Tessa Hoser from Norton Rose Fulbright. Thank you. Really interesting discussion. It follows from this, my question relates to disclosure and I guess the potential for blockchain to be used in securities transactions, not just for settlement, but if we have, for example, peer-to-peer trades in equity or debt or any other structured security, how do we deal with the potential asymmetry in disclosure? What do we do with a disclosure document that we currently might use where a security is being offered?
Kathleen, we're all looking at you.
I can imagine the boiler rooms that are working off the blockchain. That'd be wild.
Yeah, I mean, there's going to be a platform, right, where I think that you get access to the peer-to-peer functionality through a platform, and just much like when you enter into a smart contract platform, there's still some T's and C's that everyone accepts, right? That there's still a curated process for getting into the process, maybe some checking to see what kind of investor you are, where you can put the disclosures on the front end, even though the securities themselves may be peer-to-peer tradable.
Yep. So are you still contemplating that you'll have an intermediary like an investment bank that will be responsible for the accuracy of that disclosure? I guess what you're saying is the normal process is just going to sit on top of a blockchain functionality, which will make it more efficient.
I think that's right. I think in the short term, it's going to be much like the current structure, and you're going to take as few pieces out of the picture or the stream as possible, and you still will have responsible parties. But and people will make I think some wise judgment calls about pulling an intermediary out of the picture where there is a useful function being performed by them.
Hopefully we can do it better too, instead of just all the stultifying boilerplate that you find in these things that consumers don't read, and which only gives the fraudulent seller some cover in a legal context. Hopefully we can get through some of that and have more honest relationships and better written contracts, and not just inherit all the problems.
Yeah, but that requires a change to something that has nothing to do with Bitcoin.
Yeah, that's right. But if these folks up here are writing the contracts, then it will have a lot to do with Bitcoin.
All right, everyone, we're out of time. I think the speakers will stick around if anybody has any other questions. Thank you very much.